Welcome to Jerry Beckett's Industrial Manufacturing Podcast. We are excited to have our next podcast in our latest series, Recession Readiness Strategies to Take the Lead, where we are exploring a variety of strategies manufacturers can implement to proactively rein in costs while simultaneously reinvesting in growth. I'm Joe Haehner, and I'm a partner at the firm, and I focus my practice on developing and executing multinational operational strategies. Last week, we had the pleasure to talk to Steve Holliday about adjusting operational strategies. Today, we will be exploring more tactical activities. I'm thrilled to have Jim Holman with me today. Jim is a director within our firm's digital advisory group and has more than 25 years. Jim is a director within our firm's digital advisory group and has more than 25 years of experience advising clients specifically with digital transformation, IT strategy, business process optimization, and analytical reporting. His strategy and operations group consults with clients to improve and re-engineer business processes, eliminate non-essential procedures, and reduce costs. He serves as the firm's supply chain lead with the Consortium for Advanced Management International, CAMI. Before joining Jerry Beckett, Jim worked for a boutique consulting firm. He worked as an IT director for a Fortune 500 specialty chemical company and as a senior information technologist. Welcome, Jim.
Thanks, Joe. It's great to be here.
Good to have you. Let's dive right in. From your perspective, Jim, what decisions can industrial companies make to improve their financial position in anticipation of a recession that will not need to be undone when the economy begins to improve?
Yeah, that's a great question. We work with a lot of organizations in the mid-market, upper and lower mid-market. These companies coming out of the pandemic, they face significant disruption in their supply chain from both a material and a labor shortage perspective. So some of those material and logistical constraints are a bit better, and labor has settled into the new normal, which basically is less experience due to high turnover, and it's still below pre-pandemic levels. So these types of shortages are still hanging around. However, many sectors are now starting to see slowing demand, as you referenced. Housing, luxury goods manufacturing, low-end computers as examples. So to best answer your question, process optimization is a good place to start. These efficiencies that you'd bring to your organization will not need to be undone, which is the point of the exercise. Industrial companies should really ask themselves these questions. Which processes can we change that will reduce waste, reduce cost, reduce delay, reduce errors, reduce rework, and reduce low-value activities? These optimizations can lower our operating cost, improve margins, and in many cases, increase revenues. For example, better processes means higher quality data, which means better pricing decisions, improved delivery performance, and ability to operate with reduced staffing. I like industrial organizations to do the same thing that financial services and public sector can automate, which is to look at automating processes such as accounts payable, bank reconciliation, accounts receivable. And the big one that industrial organizations have been struggling with for 30 years is to reduce reliance on what we're calling paper anything, even into the administrative area, such as paper checks, paper work orders, paper purchase orders. What I want industrial organizations to think of is if you print it, consider changing it.
Great thoughts, Jim. Now, from your perspective, which of these activities would you pick? So if an organization has, only limited resources, only limited time, limited capacity, and a limited budget to work with an organization like us to engage an outside firm to help them, what would be your focus? What would you say, okay, here are the, biggest bang for the buck, or, quick wins?
Right. Yeah, that's a great question. So we like to look at where do we have money left on the table? We would engage with organizations to look at the big ones are going to be bad debt, slow and obsolete or slob inventory, What is inventory that's carrying their books that they've made obsolescence reserves for, taking up space? And then the big one is accounts payable, where, and we'll talk about this a little bit later, but where are there opportunities that if we could pay our suppliers quicker, we could get an early payment discount? So those are quick wins. They're easy to identify, and deployment of the solution is fast.
Great, very helpful. Now, what opportunities exist during a recession for industrial companies in partnering with their upstream supply chain partners?
Yes, we work with some organizations, some global supply chain participants, such as ATI Metals, one of the largest suppliers of titanium for aircraft manufacturing, and even the US Navy. And there's been some new ideas that have been brought to the table, which is looking at vendors really as strategic partners. And when you engage with your suppliers, you'll find that they are very interested in improving the digitization of their customer relationships, which in which case you will be. Most of these vendors that have survived and thrived during the pandemic are considering their own optimization and costing strategies. So some examples is a large increase in mid-sized companies re-embracing digital trading standards, such as EDI, to improve transactional communications and drive out costs. So your vendor would probably be a willing recipient of your digitization because they are doing it as well, or trying to. Other opportunities are the sharing with key suppliers your forecasts. It's been possible for years, and to be honest, a bit controversial. If your vendor is not truly a trusted partner, they're merely a supplier of parts. But with any impending change in an economic situation, like we may have with a recession, data sharing is more important than ever. Sharing the trends that you detect in your customer base, for example, what, when, and how they purchase, can be even more important to your suppliers as they line up their supplying inventory and pricing contracts. Lastly, consider multi-year contracts to lock in prices and confirm inventory availability, but only for trusted suppliers that are on sound financial footing. Even if the supplier is not the cheapest, we recommend that consider running a D&B on your suppliers. If you would not put your supplier on net 30 terms, don't buy from them.
Great. Now, Jim, from this explanation, would you say that, and some of my clients are doing this with us, basically, we are helping them to use predictive analytics to better forecast and be more prepared, look at some parameters outside of their control, but with impact on their production, on their sales, on their revenues. Would you say this information could also be shared in an arrangement with suppliers?
Absolutely. We're even seeing some value pre-sale in sharing pre-sale trends with data and analytics. For example, there's been the opportunity, and in some suppliers, for example, in commodities markets, require their customers share forecasts. But there's never been any skin in the game or incentive for the customer to ensure an accurate forecast. What we're seeing now is value in sharing data from your CRM and business development activities. What are you quoting? What are quotes that you're not winning, and why is that? It could be that if we offer 3 different variations of the manufactured product to a customer, we've logged this in CRM, there's 3 different quotes. They choose one, understanding why the other ones weren't selected. For example, is it because of price? Is it perceived quality, ability to deliver? All of those things roll up to the suppliers of those components because they have a direct influence in the price of the component, the ability to deliver, the quality of the product. So these things can help vendors almost look at a lost sale downstream.
Right. So it's almost like a win-win situation in this scenario.
It is. But like Ronald Reagan said to Gorbachev, it's trust but verify. Right. So we're going to trust our vendor that's going to be a good steward of our data. Can you imagine the disruption it could be if they shared this type of data with our competitors that they may also supply?
Right. So you want to build that trust and put in guardrails with
Sure.
that.
And it is possible to redact some of that content, to be fair.
Right. Now, touching on inventory a little bit in our next question. So what do you think, what can manufacturers do within their assembly strategy to basically maximize labor utilization without building up excess finished good inventory? So what we see right now with a lot of manufacturers driven by supply chain issues and challenges, they're building up inventory, they're building up their buffers, which is costs and a negative impact on their working capital. So it would be interesting to hear from you what you see and what you think, how this could be optimized.
Yeah, I know that the automotive sector, Joe, is near and dear to your heart. And what I like is the make to stock and make to forecast, which automotive has always been such a long manufacturing process. It's always been make to forecast. Beginning of the pandemic, the certain colors, the certain variations of General Motors, Ford cars on the lot was all based on forecast. And the disruptors, for example, Tesla had a model that was a configured automotive sales cycle, which meant they may have a showroom and have an example of a car, but they didn't have they didn't have a lot full of every available model. So what we would like is these make to stock and make to forecast models should take a page from Club Car, which is one of the largest manufacturers of golf carts, Tesla, and now Ford is an example that's hopped on that model, which is to hold off on final assembly inventory and determine at which point in your multi-level manufacturing process can you pause just short of the final product to allow for configuration and customer choice. Think of it as a near finished good, which you can then flex into different available options that a customer can choose. So consider these finished sub-assemblies, or you could perhaps have bought in components that can flex into many different finished goods. And then finally, invest in the capability to complete. Invest in this expertise so that finished goods are produced at the last possible moment. Understand this puts pressure on process and systems, but enables your customers to have more available options of the different variations of the products you can offer them. And understand that a new challenge could possibly be excess manufacturing space, excess warehouse space, which we'll talk about later. But consider the final assembly to be physically located closer to the end consumer, which can be an interesting value proposition to offset the fact that you may have reduced visible showroom inventory.
Right. No, I mean, talking about inventory and labor costs specifically with the challenges a lot of our clients face and our firm, looking at the labor market and the challenges a lot of our clients face, a lot of topics and questions we receive right now are around process automation, robotics, kind of instead of filling the open roles with new bodies, you basically, because you don't find them, you basically go out and see if you can replace or be more efficient by using technology. We also see a big push for bringing manufacturing back to the United States, and to be cost competitive, you need to look at these measures, and we most likely cover the topic nearshoring at some point in the future in a separate podcast.
Yes.
So from your perspective, which areas offer the shortest return on investment for industrial companies for process automation during a recession? So what could they do, or what can they employ, what services can they do to reduce the time to see positive impacts on their organization?
Yeah, that's probably our number one question when we are trying to sell consulting services ourselves. And we have clients that are skeptical. They've had consultants that come in and promise very fast ROI. But once these industrial organizations say, look, we've tried this before and the return on investment just doesn't materialize quickly enough. We are under potential cash considerations. Everything we do, every consulting and automation initiative has to fund itself plus. we have to treat it like an investment. If our rate of return on process optimization and automation doesn't exceed what we could get investing in the stock market, why would we do it? And I would love to say it's robotics, but it isn't robotics. Long-term investment in robotics is right now a little bit shaky because we don't know where these robotic manufacturing automation elements should be located. So as we discussed previously, back office systems and processes are a great place to start and have the easiest business case to make and the fastest ROI. So as we talked about earlier, accounting, other organizations where you're not touching the product, it's not customer facing, and it's not supplier facing. There's a reason why so many smaller organizations are outsourcing accounting altogether. So consider accounting in an industrial organization which tended to have larger accounting firms than otherwise would be in a service organization because of the complexity of the industrial model. There's a really good chance industrial organizations still have a short-staffed accounting department. So what if you could optimize, automate your processes so you didn't need to hire a replacement resource? So we found on average, our industrial clients are 20 to 25% understaffed in administrative resources, and their processes require full staff. What if you could automate and optimize your processes to lower your cost and reduce the need for the headcount you can't fill? So we start by saying, look for your vendors that offer early payment discounts and determine how much can be saved, assuming you have the cash to do so, by paying early. For example, 1.5 off if paid within 10 days, net 30. If your processes are poor, there's a really good chance you can't move that invoice from receipt to electronic payment because you're probably doing a paper check. You can't do that in 10 days, even if you have the cash. Think about organizations that are purchasing $300 million worth of components. What's that worth if they can take advantage of early payment discounts? Those things can fund themselves right away. The ROI can be 3 months. So as we mentioned, look for open staff positions you're not able to fill. Look for time spent getting bills paid, or on the AR side, payments matched to invoices. Look at past financial audits where accounting risks have been raised. For example, have you had issues with segregation of duties? Has it been noted that you have fraud risk or actually had a past fraud incident? Think about the pressure on segregation of duties when you're supposed to have an accounting department of 8 and now it's 6. Now we're having the reduced staff have to do more jobs. And there's a really good chance you're going to have staff members that will have to process purchase order receipts and prepare checks for payment. Think about the pressure and the issues that you could run into with a situation like that. And then look at inadequate or unsubstantiated bad debt reserves. This is where you talked about Joe data and analytics. How can we monitor our customers' financial performances electronically so that we can start to detect when our customers that may have a borderline problematic accounts receivable balance start to experience recession-based pressures of their own? Again, look at day sales outstanding or DSO trending in the wrong direction, and watch how long it takes your monthly financial close. If it's greater than 10 days, that's a little bit of a litmus test that we've looked at before, but where is it trending? If you're short staffed, it's probably getting longer. And there's also a good chance that the C-suite or the senior decision makers and leaders of your company, it takes them longer the following month to get key financial data to make decisions. So we found that you can improve relationships with vendors and customers by automating these back-end processes. And as we mentioned, you could do it with 25% fewer administrative resources. ROI less than 6 months in many cases, I would say most cases. We're working with a pharmaceutical distributor right now, and what we're finding is that automating their accounts receivable and accounts payable process, it almost has a negative ROI. We had to reformulate the calculation. It's basically month 1 after deploying the solution. Look at inventory management and stocking strategy. As we mentioned earlier about slow-moving obsolete inventory, can we identify this inventory that can be liquidated via secondary markets to free up space and generate cash? I say secondary markets because we hate to sell it via primary markets via fire sale, cannibalizing sales of our primary products. So if we can, some organizations are finding they can consolidate warehouses and distribution centers, which could save on rent. If they own the facility, they can take advantage of a surprisingly resilient real estate market for warehousing and sell or rent excess space.
Great, Jim. Thanks so much for these insights and great discussion. It is clear from listening to you that manufacturers can execute different activities to prepare for a potential recession. Maybe even take advantage by implementing some of these strategies and taking the lead after the recession.
Yes.
We invite you to follow Jim on LinkedIn to stay up to date with his latest activities. Thank you for joining us in this webcast. Jim, thanks for taking the time to be with us this morning. I'm Joe Haehner, and this is Jerry Beckert's Industrial Manufacturing Podcast Series. Thank you all for joining us today, and we hope you listen into the rest of the series. Thank you.